I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's Video Insight. The start of September marks the wrap on another company earnings reporting season for the Australian market. In my Video Insight at the end of July, I discussed what we viewed as some of the broader issues for the market heading into reporting season. I highlighted what we considered to be optimistic expectations for earnings growth for industrial companies in the coming year, implied by sell-side analyst forecasts. At the beginning of the month, sell-side analyst forecasts were implying 7.5% earnings growth across the industrial stocks in the market for fiscal 20. This is despite falling earnings in fiscal 19 and a domestic and global economy that is exhibiting at best sluggish growth. Outlook statements provided by companies generally disappointed, with forecasts for 39% of companies being downgraded as compared to just 18% of company earnings forecasts being upgraded. In this context, it's not surprising that the broader universe of industrial stocks delivered a negative return for the month of 1%, as the market tempered its expectations for fiscal 20. I would note that average earnings growth expectations for industrial stocks in fiscal 20 remain above 5%, which continues to look optimistic given the outlook for economic growth. In terms of sector performance, the most significant detractor from performance of the market was the mining sector, with the large iron ore stocks giving back some of their stellar gains for the calendar year to date. The iron ore price declined 28% over the month, as the combination of a resumption of production at some of Vale's mines in Brazil, combined with a weakening outlook for demand from China, as the trade war with the US continues to cloud its economic outlook. Surprisingly, the retailers performed relatively well during the month. While their results for fiscal 19 were generally weak, a number of retailers reported some green shoots early in the new financial year. The market was also willing to look through short-term volume weakness in the residential property and auto market, with REA, car sales, the novated lease companies and auto dealers like AP Eagers performing well. Another theme emerging from the results was the stocks that had performed badly merely needed to meet expectations to see a material jump in share price, while those that had been market darlings tended to be punished if they didn't provide a positive surprise. That's it for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.